Hello and welcome to Jazz After Dark. How you doing out there? Good? Good. We're financial advisors here at Jazz Wealth, and I'm having a hard time getting comfortable here tonight. I don't know what it is, but I think Buffalo Trace will help me out here, huh? You read Buffalo Trace? My favorite. Um, I'm going to ask a question, and then I'm going to teach you the answer, right? And this one is designed to get you to think a little further. Now, clients here at Jazz, of course, I just do it for them, right? But if you're an independent and you say, I like your style, Dustin, but I don't need your service, well, that's okay. But I want to teach you something anyways, and this is for those of you that are just forever like yearning for the knowledge of the financial industry or how to manage your wealth or taxes. And tonight in particular, we're going to focus on taxes and ETFs. And not the basic stuff either. That basic stuff, you save that for the other advisors on there. We'll save that for the other guys, huh? Oh, I just kid, I kid. Okay. Remember yesterday, or sorry, the other day, we were talking about how we can learn from Hunter Biden and Trump, right? And so I gave a couple scenarios and I'm like, well, love them or hate them, here's what we learned. And I learned so much. And surprisingly, there's a lot of pilots out there because jokingly and for real though, I said, well, I learned so much about Trump and how he manages his airplane. Bells went off and I'm like, you mean I can buy an airplane? Yeah, I'm gonna go buy an airplane. And I did, not a jet, nothing fancy. It's a Cirrus. That's the name of the plane. It's kind of like a fancy Cessna, really, and a lot faster. So super happy with that. But ultimately, I'm gonna buy that, or I bought that. It's sitting in my new hangar, not new, but it's sitting there, and I wipe it down every night before I go to bed. But I'm actually gonna get a refund from the government. So my taxable income will be zero, and I'll end up with a refund. I learned that from Trump. And we talked about Biden and some of the, Hunter Biden, and why he got paid as a board director on the board of Burisma. If you agree or disagree, that's fine. But why wasn't he just paid an income or given a bonus or shares? I don't know. So we talked about that. Tonight, we're going to talk about learning about ETFs, but not from a guy like me on YouTube, which is odd because that's what I'm about to talk about. But where do I get my information? Like, can I just watch YouTube and then make another video that replicates that? No, save that for the other guys, right? That's what those people, those other advisors and people that I've seen that are now starting to do this, they do that. They just read an article basically that I just read the same article. Anyways, let's get down to it. How are ETFs taxed? So, do you know? And particularly, how are the dividends? If you have an ETF that pays a dividend, does that count as taxable income? Does it count as a capital gain? Or does it count as something else? Completely different. This is my mistake too. I do this. I will often say on the closing beat, this ETF paid a dividend. Well, is it really a dividend? There's a lot of different ways these things work. And so how I learn about that and see what different ETFs do is from a prospectus. So the question is, have you ever read a prospectus of an ETF or whatever? Probably not, huh? I've read tons of them. And I learn something new all the time reading these. Now, they will bore the devil out of you, but they're usually about 25 to 30 pages long. And, there's a lot of fluff in there, right? So I want to teach you how to read something here because not all ETFs pay dividends that you pay taxes on. Not all ETFs that say they pay dividends actually are paying you a dividend. So the two main ways that people look at this is they say, well, when I get a dividend from a stock, an ETF, whatever, it is either qualified or non-qualified. I'm going to share with something different with you. So a qualified dividend means you get to treat that dividend as if it's a capital gain, and in particular, a long-term capital gain. So you may be taxed at 0, 15, or if you're really lucky, 20%. And that's just based on your income and the income that you've had throughout the year. So for most people, the dividend that you would pay is a flat 15%, or if you're just getting started in the game, you might pay 0 if your income's low enough. Okay? Or there's such a thing as a non-qualified dividend, which a lot of ETFs do pay non-qualified dividends. And that's because they're hybrids. They're not like, what do you call them? Index fund type ETFs. They're hybrids. They do weird things, and so they pay non-qualified dividends. And so what that means is if you get $100 as a dividend, the IRS says that $100 that you made in the form of a dividend, whether you reinvested it or not, that's the same as you going out and working a job long enough to earn you $100. It gets taxed as ordinary income. That could be unfavorable for some people because if you're in the 22% top bracket or the 24% bracket, maybe that costs you more than the long-term gain. So if we're holding an ETF in a brokerage account, we may want to think about what ETFs we're holding, right? Now, some ETFs are really crafty. They got around this a while ago. I'll tell you how this works. Let's say the ETF costs $40 a share. And you say, I'm in. I'm going to buy a share for $40. I'll take one. And the ETF says, we have a yield of 5%. They didn't say dividend, but they said yield. And we'll pay you that yield every 3 months, or every month is kind of getting more popular these days. And so you're happy as can be. You bought it for $40 and maybe they give you 10 cents a share. I don't know, whatever the yield is, they'll calculate. So I'm going to say that they give you 10 cents a share. So you bought your one share for $40. You got 10 cents. The next month, you got another 10 cents or whatever it was, 12 cents, Then you got 10 cents and 10 cents, 10 cents. And then you get to the end of the year and you're like, why? I don't have a tax form that says I earn that income. I know it's either long-term capital gains or ordinary income, right? Qualified, non-qualified dividend. I did it backwards. No, there are some ETFs, check this out. I can't legally tell you, if I share with you one, I have to share with all of them. Otherwise, I get in trouble because we're SEC advisors, SEC registered advisors, and we can't be seen as giving advice to people who we don't know their financial situation. So for clients, of course, I can talk as freely as I want. So I had to copy and paste this. This is directly from a prospectus. Blah, 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 blah. The fund may make distributions that represent a return of capital for tax purposes, and thus will generally not be taxable. They have to say generally. However, such distributions may reduce your tax basis in your shares, which could result in you having to pay higher taxes in the future when you sell shares, even if you sell those shares at a loss from your original investment. Did any of that just make sense to you guys? What's going on there? The fund is the ETF. They're saying they call themselves the fund. It's not the name of it. That in legal terms, how they say, from this point on, the company. They're just saying the fund. So they say we may make distributions back to the shareholder as a form of returning capital. Okay, let's stop there for a second. So you bought a share for $40. You got 10 cents the next month or whatever. The next month you got another 10 cents. In this case, they're saying that's not a dividend. You put in $40, we are giving you 10 cents of your $40 back. You actually didn't earn a dividend. You just got some of your money back, and usually it's very little. So you got 10 cents back. So now you put in 40, but really you got 10 back, so you're in it for $39.90. And that's what this part means here. It will reduce your basis in your shares, meaning you paid 40, you got 10 back in month number 1, so now your basis is $39.90. As the months go on, you see how you go 39.80, 70, 60, 50, 40. If the months go long enough, you could have a basis that's down to $10, right? But you paid 40 for them. And so if the stock goes to $30, did you have a gain or a loss? Your basis is $10. That's why this sentence is in here. Shares could result in you having to pay higher taxes in the future when you sell your shares, even if you sell shares for a loss. That's because you were in for $40, and every month or quarter you got 10 cents back. You did that for so long. What would that be? 10 months would be $1. Oh, that's a lot of months. Okay, so you see how long it would take. But eventually you get to a point where you might want to sell those shares. But because they returned your money, your basis is very low. So even if the stock was at 40 when you bought it, it fell to 30 and you sold it, technically the IRS says you still have a profit. Doesn't that sound like a gotcha? It kind of sounds like a gotcha, right? It's not a gotcha. It's an opportunity, right? Think of the strategy there. Let's pretend for just a moment, and only this is, I'm saying this because this just happened with a client, that you need a little extra income. You're worried about taxes, can't have your taxes go up or your income go up because you may pay more on Social Security, Medicare issues, and higher premiums and all of that stuff that we've covered in other videos. So we got to keep your income low. If we find an ETF or even build you one that pays you back the money that you put in rather than a dividend, do you care? Not really, right? You need the income, but you don't need your taxes going up. So they return your money to you month over month over month over month, right? And this gets you through your retirement. What happens? Think of the strategy. It's like so exciting. So what happens is you die. Oh, I had these shares. I got the income that I needed. My life has expired. I am done. The shares still exist. And if they existed long enough, you could have potentially gotten enough return of your capital to have a cost basis of 0. If you got 10 cents back 400 times, what is that? 10 cents back 400 times. Come on, I'm making a point here. Grab your calculator or just take a drink while I'm talking. 400 times, you got 10 cents back. So in 33 years. So hopefully you got more than 10 cents. So let's say 400, that's 33 years. Okay, cool. So you could be even younger and do this. So you get your money back. Now the shares could go up. They could go down. They could go up. They could go down. But we just said you've reached the end of your life. You have that one share that you paid $40 for. What happens after you die? It goes on to somebody, right? You may leave it to your kid. You got to leave it to somebody. Yeah, hello, right here, always here. Remember the guy that taught you. So you leave it to somebody. They get the shares, and what do they get? They get a step up in cost basis. What's your basis? You had it for 33 years getting your nice little income from your one share, your 10 cents. After 33 years, you pass away. Your cost basis is 0. It passes on to the next person in line that you give it to, and the cost basis becomes whatever the price of the share is for the day. So let's say you die, well, you have to die on a Thursday. So if you die on a Thursday, we look and we see what was the price of the shares on that Friday. $40? What a coincidence, right? Oh, it was $40. Even if it was $50, that's their new cost basis. And so they have this one share now with a basis of 50. What happens the very next month? Oh, they got 10 cents back. Now their basis is $49.90, $49.80, $49.70, right? So it's working its way down. But this is your kid, or grandchild or whatever. They're 25 years old. 30 plus years go by, and the same thing could just happen again, couldn't it? So think of when you read something like this, if you happen to, don't just skim over it. Look at things like this and go, wait a minute, you're going to return my capital. If you return my capital, it's not taxable. That was my money. Now, if you return me earnings, or you return me a pile of dividends that were not part of my original investment, okay, that's taxable. That's traditional. So, think of an index fund, S&P index fund, right? They have a little dividend, comes to you. Your investment's still sitting in there. You got the dividend, it's taxable. In this case, they're trying to give you a tip. I don't know how much cooler it gets than that. You know what I mean? That's pretty cool. So when you read something, if you're a client, of course, you can just throw it in my face and go, what do we do? And I'll help you out. But I thought that was so cool because you're solving for multiple things along the way without letting the IRS have your money, so that your dollars are not going to be thrown into the pool of the fight of the debt ceiling and all of the crap that's going on right now in Congress. Wow. Well, that seems pretty cool. All right. That's it. Just wanted to get you thinking a little bit there. By the way, read more into a prospectus. That's just one, 2 sentences? I don't know. It wasn't even like a full sentence because there's a semicolon there. Does that count? I don't think that counts. So there's one full sentence. Yeah. Lots of commas, semicolon, one sentence. What did we just learn from that? We learned there's opportunity. So if you owned this stuff in a brokerage account, don't give up and just say, well, the accountant said I just did what I did. No. Did they return your capital or not? Very, very cool. Anyways, hopefully this lesson has helped you learn how to keep more of your dough. That is my job here, doing things like this and working nonstop to learn. Well, I already knew that, but to point out to you so you can learn how these things work. Find the little silver nuggets that mean you keep more of your dollars, and that's it. And by the way, before you think, most of you know me, right? So you know there's no catch. You go to our website, right there, halfway down on a website says, this is all we charge. This is it. Depends on how big your account is. And you know, if I can help you make decisions like that, I don't make money on that. I'll just help you grow your account. That's all I ask. The investments are a very important part. You don't want to get that part wrong. And if your account grows, we as a company grow as well. If your account does not grow, we do not grow. It seems like a mutual arrangement there, right? Anyways, enough of the sales pitch. Enjoy the rest of your night. I've got some Buffalo Trace to enjoy. And it's already the next day. It's late. More work to do. Adios.